Hello? 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 Hello, yes? Yeah, yeah. Yeah, but the camera is, I'm still setting it up. Just a minute. No, the camera I have to change to front camera. So that is what I'm looking at now. I'll just log out and log in again. Hello? I'll just log out and log in again. Yeah, it's not showing my picture. So I'm just trying to see how do I control the camera. Yeah, sure. I'm just doing that, yeah. Good morning. So I am ready here to start this webinar. Can we start? Okay, so thank you so much for joining. And in the next about quarter of an hour, what I will do is I will kind of go through my thoughts in terms of early stage fundraising. But before I go on, I want to have a short poll in terms of who are the people who are attending the session. So I have created a short poll, and I just wanted to seek the response for that poll. So I'm starting this poll now. So if you could kind of indicate your background, then it will be good. So whoever is available in the session, so if you could indicate your background. I'm also allowing this show results to everybody. Okay, I think there are some responses that I have got which says that they are not able to submit the poll result. And there was one query which said that they are not able to see the results. So from my side, I have enabled everybody to see the results, and the poll is still open. So you can still submit if you would like to. And there are some responses that I hear that they are not able to listen to the audio. And before I go ahead with my presentation, I want to check, is the audio clear? Can I just have a kind of show of hands in the chat window that you are able to listen to the audio? Okay, so by and large, I find the audio is clear. So let me get on with my presentation. Right. So this is basically the poll that I have conducted, and by and large, what I find, if I look at the poll results, right, the poll results indicate most of you who are attending this session are early stage entrepreneurs, right? And then the next comes aspiring entrepreneurs. So I kind of then make my presentation targeted mostly these two kinds of participants, early stage entrepreneurs and aspiring entrepreneurs. Right? So, and before I go on, I wanted to take one more poll. So I wanted to create a second poll here. So what I am hearing is there are two statements. The first statement, the number of ideas. The second statement, capital that is needed to implement these ideas. So I would like your response in terms of whether number of ideas is less than the capital that is needed, and number of ideas is greater than the capital that is needed to implement these ideas. Okay, so we have about 7 people who have answered. I am going to show the results to everybody now. About half the participants have responded, number of ideas is less than the capital needed. Right. So my own view here is the ideas that are available are a lot more, but the capital that is available to implement these ideas are much less. The reason I'm saying this is because today there are a lot more ideas, a lot more innovations, but only a fraction of them get funding, right? So there is always going to be competition in terms of which of the ideas that are getting funded, and the capital, there is always a shortage. And given the fact that there are some of the ideas that are unlikely to get funded, right? When I say funded, I'm not saying that external funding or internal funding, I'm generally saying, right? Even on a very personal level, let us take that into consideration, right? So each of us have several ideas, right? I mean, it not be necessarily related to startups, but in our day-to-day lives, there are several ideas that we all have on a daily basis, right? But we choose to implement a few of them, right? We choose to undertake a few of them. We choose to pursue a few of them, right? So that means we decide, we evaluate based on the ideas, we decide which one is worthwhile to be pursued, right? And we kind of decide to shortlist, prioritize what are the activities or what are the ideas that we will pursue, right? So in general, whether it's the case of startups, entrepreneurship, or in our day-to-day life, I always find the number of ideas are always higher, but what we choose to pursue is only a fraction, right? The same is the case with entrepreneurship. There is going to be a shortage of capital. It could be shortage of capital, or from your personal side, you choose to implement or prioritize some of the ideas because there is shortage of time, right? So ideas are always higher than capital or time. So with this broad outline, let me kind of go to my presentation. In the meanwhile, I will also look at some comments that have come by chat. So there are some who are responding. They are not able to submit the poll results, right? So I really don't know. Maybe there are issues in the browser that you are using. I'm unsure, because there are some who are able to submit, and there are some who are not able to. So let's get on with it. But I get the sense that many of you feel. I get the sense. I get the chance that I get the idea that many of you are feeling that the ideas are shorter, but the capital available is longer. But that's not really the case. So Neetu Tiwari has just raised a question: is this seminar not for researchers? Right? So this seminar is targeted largely for entrepreneurs. It is largely for aspiring entrepreneurs, and also to a certain extent, it's for investors and advisors who work on the startup sector. There are some responses that are coming, which is saying that they are not able to hear the audio, but many are able to hear the audio. So let me get on with the presentation and then come back to the chats. So my first slide is generally giving the trend on venture investment in startups. So I have kind of taken the statistic on venture investment in startups starting from 2005, and it's a 3-year moving average to smoothen out the year-to-year fluctuations. Okay? So what you essentially see is that there has been a steady and as well significant growth in the investment that has flown in venture investment. So this obviously many of you will think it's a very positive move, and nevertheless it's a very positive signal. Definitely, it's very encouraging to see that a lot of capital, particularly venture capital, is flowing into startups. Right? So let me now go to the next slide. I'm looking at the deal growth. Right? I'm looking at the deal growth during the period 2005 to 2015. See, what happens is there are year-to-year fluctuations, but if I really look at a 3-year moving average, you really find a very classic pattern of a steady growth, right? I mean, it cannot get a better textbook graph than this, right? What we see is a growth for each and every 3-year period. Right? There has been substantial growth during the period 2013 to 15, but overall what you find is a steady growth during the period. Right? If you really look at a decade of 2005 to 2015, the deal growth has been more than 10 times. Right? So continuing to move on, I am going to specifically look at the growth in angel investors. So when I see the profile of the attendees in this webinar, I find most of them are early stage entrepreneurs, and there are some who are aspiring entrepreneurs. That means people who are thinking of starting up but probably have not started it, right? So when you start a venture, obviously there are many things that is needed. You would need a team, you would need a good business idea and a model, and most importantly you need capital. Right? So the first stage of external investment. So when I say capital, the first capital is going to come from the founders themselves or somebody who are close to the founders. They could be the family members, they could be the friends, right? So those are what is technically external capital, like not external capital, right? But usually what happens, there is a limit to which how much internal capital founders can bring to the table, and business has to grow. And during the initial stages, obviously the business does not generate the cash flow that is needed internally to fund the growth, right? You need to have external capital because the internal generation is not adequate to fund the growth. So when you need external capital, you need investors who can provide that external capital. So the early stage external capital is funded by largely angel investors, right? So obviously we all know who are angel investors. Angel investors are rich individuals who predominantly are entrepreneurs and who invest in entrepreneurial entities because they see this as a way of giving back to the entrepreneurial community, and also more importantly to be able to engage in high risk investments, right? So now this slide shows the growth in angel investors from 2008 to 2015. So just look at the growth that has happened, right? In 2008 or 2010, now the number of angel investors are still, very few, right? It's increasing, but in 2010 we just had about 50 angel investors. But fast forward to 2015, we had close to 1,000 angel investors. But if you look at the end of 2018, there are at least 3,000 active angel investors, right? So that's a phenomenal growth in the number of angel investors. So let me kind of take another poll here. So much of growth in angel investors, right? I'm starting this poll. So much of growth in angel investors has resulted in what? Does it increase the probability of funding? Has increased the difficulty of finding the right investor? Led to a higher growth in the number of startups, or none of the above? Okay. So I wanted to get your perspective on what do you think has actually happened as a result of the growth in the number of investors. Okay, so there are 11, 12 people who have answered, 13. I will show the results to everybody. So there are two dominant responses, if I may say so. the first dominant response is increase. Growth in the number of investors has increased the difficulty of finding the right investor. And two, because there are more number of investors, there has also been a higher growth in the number of startups. Right? Both of them are fairly very good responses. Right? So let me kind of take a view here. Ultimately, in any startup, the number of investors who are going to invest is going to be a handful of them. And out of a handful of an investor, there is going to be one investor who's generally likely to be the lead investor. So the lead investor is going to be responsible for supporting and also mobilizing capital from other like-minded investors. Right? So finding the lead investor is very important, right? Finding the person who is going to make this investment is very important. Now, when there are 50 investors, finding the right investor, the probability of finding the right investor is 1 by 50, right? Now, when we have 3,000 investors, probability of finding the right investor obviously becomes much lower. It's like having a typical probability problem, high school probability problem. So you have a bag or a box, and then you have 50 balls of different colors. The probability of choosing a ball of the right color is 1 by 50. Now you have another box where there are 3,000 balls, and then the probability of choosing the right ball and the right color is 1 by 3,000, right? So growth in the investors has also been a challenge, right? On an average, it has increased the probability of funding maybe, but finding the right investor is become a big challenge. Right? So that is something entrepreneurs need to be aware of, right? Overall, there has been a growth in funding environment, but the challenges still remain because the competition for funding has increased. There has been increase among prospective entrepreneurs in starting up, and there has been increase in number of investors, but finding the right investors is obviously going to be a difficult challenge. Right? So let me close this poll for now and continue with my slides. Right? So I am going to talk about this slide, which shows the funding trends in successive rounds. So the first thing that entrepreneurs need to be aware of is all the investment does not happen in one round, right? Entrepreneurs tend to raise capital over multiple rounds, right? There are a variety of reasons for this. The first and the most important reason is when the entrepreneurs raise capital over multiple rounds, they are able to take advantage of higher valuation that happens because of demonstrated performance of the earlier round, right? If the entrepreneur is able to demonstrate superior performance in the earlier round, then the next round investor is willing to, be prepared to give a higher valuation. So that means an entrepreneur will have to dilute a lower shareholding. And second, the investors also think if there is staging, that means if the funding is happening in multiple rounds, there is incentive for the founders as well to perform. Right? If all the investment happens at one go, then obviously there is not enough incentive for the founders to continue to deliver performance. Right? So what we have done now here is we have taken the landscape of funding trends in successive rounds. Right? So for example, we have a situation where there are 875 startups, right, that get formed. Out of these 875 startups, only 75 are able to get the first round of funding. Right? The first round of funding can happen from different sources. Right? It could be from angel investors, it could be from other funds, whatever it may be. But only 75 out of 875 are able to get some funding. Right? So this is as per whatever is available data, right? Most of the data may not get reported, either the startups that get formed or the deal that gets funded. But among the reported deals, 75 out of 875. So that means less than 10% of the startups get funded, right? Remaining 90%, they don't get any funding at all. And of those 75 that get funding, we look at startups that have been a part of accelerators and incubators, and startups that are not being part of any incubator or accelerators. So if you really look at the proportion here, out of 875, 55 have been part of accelerators and incubators, right? And the remaining 820 have not been part of any accelerator or incubator. And 11 of those 55 has been able to get the first round of funding. So that means a ratio of 20%. Whereas if you really look at those that have not been part of any incubator or accelerator, the ratio is much less. So the bottom line here is being a part of an incubation or an accelerator makes the startup investment ready and increases the probability of getting funded. So next we move on to the second round. So what we find is the biggest hurdle in terms of getting funding is in the first round, right? After the first round has been funded, the subsequent rounds, the probability of getting subsequent rounds increases dramatically. For example, 75 out of 875 gets first round of funding, that is less than 10%. But second round of funding, 15 of the 75 have been able to get. So that means it's about 20%. Right? So the probability of getting doubles in the second round. And if you look at the third round of funding, 5 out of 15 are being able to get the third round of funding. So now the probability has become 1/3. Right? So for each and every succeeding round, the number of, the probability of getting funded increases, which is good news for the entrepreneur. Right? So that means if an entrepreneur is able to show performance in the previous round, the ease with which the subsequent round of funding can be obtained is higher. I will move to the next slide, and after describing this slide, I will probably take a short break for questions and for any observations that you may have. So this graph indicates the proportion of startups in different stages. Right? There are two lines. Right? There are two lines, the dotted line and the red colored line. Right? The dotted line and the red colored line. The dotted line indicates the percentage of companies that have not been funded at different stages of the startup life cycle. Okay? And the red line indicates the percentage of companies that get funded in different stages of the startup life cycle. So let us look at the different stages, right? The startups we have classified across 5 different stages: the ideation stage, the proof of concept, launching of the beta, then you have early stage revenues, and then the late stage revenues. Right? So we really have the startup life cycle in 5 stages. So if you look at the ideation phase, in the ideation phase, the proportion of startups that have been funded are lower among the total startups that have been founded, right? The proportion of startups that have been funded at the ideation stage is lower as compared to the proportion of startups that are founded in the ideation phase. Now, as we move along, when the startup reaches the beta stage, there is a crossover, right? The funded line crosses over the not funded line. So that determines what is called as in a certain stage, an inflection point, right? The probability of getting funded increases dramatically once a startup reaches the beta stage, right? Once a startup reaches the beta stage. Before that, the proportion of funding, the probability of getting funding is lower. So what is the takeaway here for the startups? The takeaway here is, if you are able to have a beta launch before going for external capital, then your probability of getting funded is much higher as compared to going at an ideation phase. Right? It is useful to look at funding by founders and families till the beta launch phase, because external investors investing during that stage is going to be very few. So what I will do now is I will take a short pause here and see if you have any questions, and we can throw the webinar open for some questions and discussions. There have been some comments that have come on chat. Let me try and look at it. So Deepak Sahu has agreed with the comment that there are a lot of angels right now, but has been finding difficult to find the right investor who can add value. Certainly, there are a lot more people, but finding it is very difficult. People have been going through a frustrating experience. I mean, frustrating is probably the right word that many people have told. Right? And then there is a chat from Ganapati Ajay. What happened to the 800 that didn't get first round funding? Is a mortality 85% there? May not be. I just wanted to highlight here that substantial number of startups need external funding, but not all of them need external funding. In fact, many of the businesses may not even go for external funding because they do what is called as bootstrapping. If the business model allows themselves to be bootstrapped, then many people don't go for external funding. In fact, there are several companies who actually prefer to bootstrap, because when you go for external funding, then you are kind of answerable to the investors. There are a lot of conditions that come with the funding, and if at all possible, many people bootstrap. Right? Like for example, I will give two reasonable good examples in given scenario. Let us say, for example, Zoho, right, the platform on which we are having this webinar. So Zoho is obviously bootstrapped, right? Zoho is bootstrapped, and then there is Latent Technologies that is also bootstrapped, right? So bootstrapping is also a strategy that many of the companies follow. Then Nived Narayanan has raised the question: till what stage is bootstrapping recommended? When is the right time to approach an external entity like an angel investor, right? See, if you really look at the US, angel investors are those who invest at the idea stage. You don't even need to have a PPT, right? You just have an idea, and then you can probably find risk investors who will invest small amounts. It could be about $100,000 as well. Right? Now, having said that, in the Indian context, angel investors don't have the same level of risk appetite as what we have in the developed countries. Here, even an angel investor is looking at certain amount of progress, certain amount of performance before they can take an investment, right? So people are looking at a minimum a beta launch, right? So that has also changed over time, right? For example, 10 years ago, an angel investor is possible to invest at an idea stage, but today, given the fact that there are so many startups, the angel investors can afford to be very picky and choosy. And therefore, they are expecting a lot more progress before they can go ahead and get funding a startup. Then there's another question from Ajay Ganapati. Please define beta launch in case of startups. Is it working software plus revenue, or just working software, right? So revenues is the early revenues. So in a beta, it's largely a working software, and it may not even be full-fledged, working software, right? It could even be something that is the MVP stage, but that is what we mean by beta launch. Then Bharadwaj has a question: where do you find a good source of finding angel investors? So there are plenty, who will find angel investors, But I would also give you certain amount of statistic here, right? So today you have a large number of angel networks, right? Angel networks are a group of networks angels who come together and fund a company. There are plenty of angel networks. Probably India Angel Network is by far the largest network, right? But also just look at the odds of getting funded by India Angels Network. You would find the odds are even much lower than probably the JEE, what we write the JEE, right? So my understanding is that India Angel Network gets about 25,000 proposals every year, and they fund between 1.5 to 2 deals in a month. So that means they fund about 18 to 25 deals in a whole year, and they get about 25,000 in a month. So that's a kind of a proportion that we are looking at, right? Is the list of angel investors public? Can we utilize the services of Winehouse.in? Yes. Now Winehouse.in has been specifically set up with the purpose of increasing your chances of finding the right angel investor. Right? See, for example, angel investors utilize their investment banking. It depends on a lot of factors, right? And those factors largely vary between angel investor groups, right? So our research, through our research in the last 10 years, we have been able to identify factors that people look at when they make the investment decisions. So using those factors and using data sciences and machine learning algorithms, Winehouse.in is able to recommend investors to you who will be a best fit for the kind of for your kind of a startup. So then what happens is, obviously startups are able to quickly identify who should they start. That gives a starting point. And that many people found has been extremely beneficial, right? So I'm still trying to look at some of the chat questions. Okay, some of this will get addressed as I go on to the subsequent slides. So what I'll do is I will continue with the presentation, and after a few minutes, we will again take a pause for some of the questions that you would have. Okay, I'm going to take an example of a simple example related to schooling, right? So when I really look at the schooling in my parents' days, right? So it started with elementary or primary school. People stayed at home till the age of 5 or 6, and then they all went to the primary school. Right? And then when I looked at my time, many went with nursery school, and then they went to the primary school. Right? So people entered school at 3, and then they went to the primary school. Right? So the general feeling is that when you are a nursery, it prepares yourself better for entering primary school. And it would be extremely difficult to gain admission in primary school, in some of the well-notable primary schools if you have not been in nursery. Right? I mean, in most of the schools today, it is difficult to get into primary school without getting into nursery. So that's the situation that we have. Right? But what about for my children? So today, it starts even before nursery school. It starts with play school, then nursery school, then primary school, right? So increasingly, what schools are expecting is when they enter, right? When the students enter, they want them to be a lot more prepared. They want them to be better equipped than in the past. Right? Today in nursery schools, many people expect some amount of stint in the play school before they come to nursery school, right? So the same is happening in the case of startup funding. Okay? So most of the angel investors are today expecting the startups to go through an angel or an accelerator before they approach for funding. The reason is many of the angel investors feel they don't have adequate time to mentor the startups. They don't have adequate time to kind of put in place the process and all of this that a business demands. And when a startup goes through an incubator or an accelerator program, they are more investment ready. Right? They are more investment ready, and that subsequently reduces the risk for the angel investor. Right? So we have also seen this in the funding trends, where a startup part of an incubator and accelerator program has a better chance of funding. The point number 2 is half of the incubators are located in Tier 2 and Tier 3 cities. And the ecosystem, the entrepreneurial ecosystem in Tier 2 and Tier 3 cities are not as strong as what you have in Tier 1 cities. Right? The exposure is probably not as high. So what happens when startups in Tier 2 and Tier 3 cities become a part of incubator? They get a lot more stronger. They become much more investment ready as compared to approaching an angel investor right away. Right? So aspiring entrepreneurs would be happy to bear this in mind. Today we have very extensive incubator network. We have several accelerator programs that are being done by corporates or even specified accelerators like Y Combinator and so on. Right? So in fact, accelerators run like a batch. Right? You have Acceler, you have Y Combinator, you have several who actually try and do it as a batch. Right? So all of them help the startups to quickly able to understand how do you really identify a business, evaluate a business, and if the viability is not seen as attractive, then it also helps the startup founders to drop a business idea rather than burn capital in the subsequent months for a business that is unlikely to succeed. Right? So early discovery of viable businesses is also enabled by incubators and accelerators. So now let me go on to the next slide. So in the next slide, what I have shown here is results from an angel network. And this angel network looks at a variety of different proposals, and depending on whether they invest or not invest, they give a feedback, right? So we were able to compile this feedback, and this feedback we classified into 2 types, positives and negatives or concerns, right? So if you really look at the positives in both invested companies and non-invested companies, right? There are various factors. And then the blue bars indicate companies that have received investment from the angel network, and the red bars indicate the companies that have not received investment from the angel network. So the first thing that comes to your mind is what factors have the highest number of positives, right? So if you really look at it among the various categories, you have market size, and then uniqueness and product strengths have the highest number of positives, right? The next comes the competency of the entrepreneur, right? Next comes the competency of the entrepreneur. So this will probably give an indication to you on which factors the angel investors consider the most important when they make an investment decision, right? So most of them give a highest priority to the market size and the uniqueness of the offering. Second factor that they consider important is the competency or the quality of the entrepreneur, right? If the quality of entrepreneur is very good, but the market size and the product strengths are not attractive, then it is unlikely that the venture is going to get an investment, right? So it's important to focus on the market size and the product strengths. The second point that I would like to highlight here, if you try and compare the differences between invested and non-invested companies, the number of counts is not significantly different between these two groups, right? Obviously, the count of positives is higher for the companies or startups that have received investment, but the difference between the counts of invested and non-invested companies is not very high. So this is an important takeaway is what I feel for the early stage entrepreneur, right? The takeaway is there is a very thin line of difference between startups that get invested and do not get invested. It's not like being black and white, right? There are a lot of shades of gray. So this makes it even more difficult for the entrepreneur to identify the right investor and so on, because there are no strict criteria, and companies that have not received investment also do have some positive factors. And inferring that some startup have made an investment and therefore a similar startup should also get an investment may not be the right approach, right? So now let me look at the next slide. So the next slide indicates the concerns, the count of concerns in invested and non-invested startups, right? So here what you find, the concerns are obviously higher, right? The concerns are obviously higher in companies that have not received angel investment. But it's important to note that even the companies that have received investment have what I would say some shortcomings or concerns, right? But if you really look at it, the concerns have to be kind of addressed using appropriate business strategy. So that is what the investors are looking for. It's not that a proposal does not have any weakness. The weakness should not be, I would say, in important factors like market size or things like that. If you also find the valuation and fund requirement, the count of concerns for the invested companies are higher, right? So very strange, right? So it means what? Most of the companies that have been able to receive investment are either asking for too high a value or they are asking for a higher fund requirement, right? So sometimes if the valuation expectations, there is a big gap between what the investor is prepared to give and what the entrepreneur wants, then that can be a concern in the sense that there can be a lot of heartburn between the investor and the entrepreneur, and that is best avoided. So the takeaway from this slide I would like to say is, yes, as a company, you have received investment, but still you would have some concerns. And if you need to be successful, you need to be able to see how these concerns should be strengthened in the subsequent rounds. So now let me go to the next slide. So I will give you some statistics on the companies formed, the companies that have been founded, and the companies that have been exited, right? So I would particularly request your attention on the pie chart kind of a graph that you have, right? So if you really look at it, the outer circle reflects the number of companies that have been formed, right? The outer circle reflects the number of companies that have been formed. So the number of companies that have been formed in smaller cities are higher. 68% of the companies that have been formed are in these smaller cities. The larger cities account for 32%. Right? If you look at the inner circle, that's the middle circle. The middle circle indicates the number of companies that have been funded. Right? If you look at that, the proportion of companies that have been founded, a majority of them are in the larger cities, right? 89% of the companies that have been funded by venture, they have been in larger cities. And the innermost circle indicates the number of exits. So this is very similar to the proportion that we see in funding, right? Companies in larger cities are able to provide an exit to the investor. So what is the implication? The implication is angel money tends to flow to startups that are mostly in larger cities. Right? So what happens to startups that are funded in smaller cities? Right? So startups that are funded in smaller cities will be better off, as the numbers indicate, to look at those sources that may be other than angel or venture investments, at least in the initial stage, right? For example, today there are several investment sources that are available. So one should be in a position to look at those sources and growing to a certain size before they start approaching venture capital. And I'm going to kind of give you some indicators of another data set that compares invested and non-invested companies, right? So this is a compilation that we made from a very well-known angel network based on their deal flow, right? We compare companies where they've received investment vis-a-vis that did not receive investment, and we look at the various categories. The first is, let's say, company stage. At what stage the company was at the time of raising capital? Were they pre-revenue or are they post-revenue, right? If you really look at the companies that have received investment, the ratio is 86 to 14. So that means 86% of the companies that have received investment were in the post-revenue stage. So this gives you an indication of what do the angel investors consider important in today's context. They want some amount of revenue, right? Pre-revenue is essentially going to be supported by incubators and other kind of funding, but angel investors are going to look at post-revenues. Then you consider the amount or the investment requested. The investment requested by companies that have received investment is actually lower as compared to companies that have not received investment. Okay. So frugality, or the ability to economize spending and achieving the maximum for a given amount of capital, is considered to be a big positive by the investors. Okay. So not overinflating the fund requirement and taking only what is needed to be able to sustain till the next round or sustain till achieving, the business sustainability is important. Invested companies also have a higher average run rate, like for example, about 5 crores, right? The 5 crores is the average annual revenue run rate for companies that have received investment, and companies that have not received, it is about half of it. Average investment made by companies at the time of applying to the angel network, so that it's not much difference, right? It's about close to 70 lakhs, right? So that's the amount that founders and their close network have made an investment in the venture before they started applying to the angel network. So this kind of gives an expectation as to, if today, in today's context, if an entrepreneur goes to an angel network with no personal skin in the game or with just an idea stage, it's unlikely to receive support simply because today there are so many angel deals available in the market. The competition is very high and investors are becoming picky and choosy. So therefore, one needs to be able to show substantial amount of progress and performance. And then finally, if you really look at it, how do you approach the angel investor? Some kind of reference helps. Sending out an email and what is called as a spray and pray kind of an attitude is unlikely to get any response, right? So it needed what is called as a headhunting or a targeted search of the angel investors, and going through a reference is going to be a lot more beneficial rather than just applying by email or through the web application. So I have kind of given you a quick overview of some of the factors. I would probably take another 5 to 10 minutes, but before I do that, I wanted to take a few minutes off and respond to any questions or observations that you may have. So let me open the chat. Bharadwaj is asked, what is the difference between an incubator and accelerator? If a startup is incubated, is it better to approach an accelerator before going for external investment? So Deepak has also given a response. Incubator is usually for developing the product company before scaling. Accelerator is usually for assistance in scaling. So there are different ways one can look at it depending on what is the type of accelerator. So many times, but the big difference between an incubator and accelerator, I would see, is in the duration of support. Accelerators largely run what is called as short duration programs, right? Up to 100 days, right? Whereas incubators provide support up to even 2-3 years as well, right? So the duration of the support varies. And in some cases, accelerators are even before the company has been formed, at the idea stage, right? So accelerator will be able to quickly indicate or inform the entrepreneur whether there is prima facie viability in the business before substantial investments are made. So accelerators in some sense helps to save capital which might have otherwise been wasted in unviable business. Accelerators help to identify companies whether it's worthwhile to be further invested, right? And incubators, on the other hand, make investments, right? It could provide infrastructure support, it could provide professional services support, it could provide mentoring support, and all of the other things, right? So that is the difference between an incubator and an accelerator. So the normal trend is to be able to go to an accelerator first and then get incubated of those businesses which were seen as viable at the end of acceleration. So Sirish Shomanchi has said, does IITM have an incubator or an accelerator? Is it possible to participate even if you are not in Chennai? Yes, IITM has an incubator, and incubator is situated in the IIT Madras Research Park, and the research park also has an accelerator called Accelor. So depending on, the policies of the incubators are different, whether online incubation is possible or whether one needs to be physically present. So you have to discuss with the IIT Madras incubator, and it is done on a case-by-case basis, whether the incubator has to be in Chennai or not. I know personally of instances where the companies are based in Bangalore, but they took the incubation facility. Remember, the head office need not be always in the incubator. The head office could be elsewhere, but being present in the incubator provides a lot more advantages rather than just being an offline incubating. Umesh Chandra has asked, in which category does research grants fall? Research grants normally don't really look at commercialization by and large, except in the case of instances in biotechnology, Department of Biotechnology, Government of India, right? So research grants is essentially is up to an invention stage, right? And from the invention to the innovation, is where commercialization happens, right? And research grants are essentially even before angel funding, right? So one uses a research grant to be able to identify a potential product, and to be able to develop the potential product further, one needs venture capital or angel investments. So Deepak Sahu says that IITM does not support virtual incubation. Ganapati Ajay has asked a question. Corporate run funded incubators or accelerators are also being considered as angel investors for this analysis. A question mark. See, incubators and accelerators, in most cases, they do not provide substantial amount of funding, or they provide substantial amount of funding to a subset of companies that have been incubated or participating in the acceleration program, right? So when they receive substantial amount of funding from the accelerators, in some sense, they are most likely to be received as a venture fund rather than an angel investor. What characterizes an angel investor is an angel investor invests their personal capital, and they are not managed like a fund-like structure. Right? Whereas accelerators, when they make investments, they also make investments that they manage as fiduciary capital. So in that case, accelerators may not be angel investors, but they would be more akin to a venture fund. Right? So what I will do now is I will just take a couple of minutes. Okay, before I do that, there's another question from Aparal. What should be the ideal time between stages from ideation to investment? Right? So let's kind of look at it. Ideation is a stage where you are starting a company. My first thing is it depends on sector to sector. Let me give a very generic response. Ideation, let me say, is the first step to start a company, and an angel investor would prefer to make an investment before 3 years after the incorporation of the company. Right? So from ideation to be able to reach a stage where you get investment, it's preferable that it is done before 3 years, right? For a variety of reasons, because the idea might lose relevance after 3 years, given that today's world is very fast changing, right? So it's always good to have a deadline, right? I need to move from ideation to the proof of concept or minimum viable product or beta within a span of 2 years or maximum 2 to 3 years. If we are not reached that stage within 3 years, then the proportion of startups getting angel funding dramatically drops, because the angels might think that the idea is no longer relevant unless until the promoters have substantially revamped themselves. Okay? So that's my response to that question. So what I'm going to do right now is also, as somebody who's been researching in this, we didn't want our insights and findings to be largely, to meet the needs of academic world. What I have done is we have used the research insights to be able to come out with a venture, and that venture is called YNOS, right? YNOS. So you could go ahead and check that, check our website, ynos.com. Here I'll briefly talk about, how we are trying to address the challenges faced by entrepreneurs. Right? Entrepreneurs face a variety of constraints. The first is information, and second is capital. Right? So these are the two major constraints that the investors face, particularly startup entrepreneurs face, because they don't have the resources to be able to buy information, and neither do they find the market to be able to hire the talent to raise capital. Right? The investment bankers who play a very important role in raising capital, today they no longer fund the startup, because they think the risk is very high and the funding requirement is too small. So essentially, without investment banking that will help the startup, it will be very difficult to raise funding. So what we thought as a company, YNOS, is can we use technology to be able to address the challenges faced by the entrepreneurs, right? Which is essentially to say, okay, here are the list of investors that you may be able to approach for investment. So we have created a technology platform that provides the following offerings. For example, Insight. Insight is a dashboard that provides the landscape of the startup. It's customized to your startup. So if you would like to know what are the kind of business models, whether it is B2B or B2C, how many startups are there in different parts of the country, and when were the startups founded, which gives you an indication of how much progress they have already achieved, right? And what is the kind of valuation that the startups have been able to get at the time of funding. So this is a dashboard that Insight provides. So this can be very helpful to be able to identify whether it's worthwhile to even get into this business, looking at the competition or the existing kind of startups. So our next solution is Verve. This is basically to give an understanding of the valuation of the startup, right? So if you kind of reach the stage where the investor is keen and you are also keen, the chemistry is matching between the investor and you want to go ahead and complete the investment, the final stage is a valuation, right? So what I have seen is in many cases there is such a big difference in the expectation of the investor and the entrepreneur on the valuation. Now sometimes the difference is to a multiple of 30 to 40 times as well, right? That's the kind of difference that I have seen when I was in the venture industry. So when there is such a big difference in expectations, then what happens is the deal could get sour, right? The investor sometimes could not agree to the expectation of the entrepreneur and he pulls out of the deal. Right? So to prevent this from happening, what we have tried to give in our platform is to give an estimate of the valuation range that a startup could expect. It's like trying to expect what could be the salary that one can get from the markets. Very similar. What could be the market valuation of my startup? And that gives a realistic check, right? So it's unlikely that you may get a valuation that is too different from what's the market reality. And this helps you to pitch with the investors on a more confident basis, right? This is the valuation that companies related to my startup, companies that are similar to my startup have been able to get. So therefore, I am asking for a similar valuation. You will be able to justify your valuation a lot more to the investor using this tool. And then finally, there is this Discover, which helps you to identify the right investor. See, finding the right investor is not by chance. Finding the right investor is never probabilistic. Finding the right investor takes a lot of effort, right? There are so many factors that one needs to consider before even approaching to see whether he's the right investor or not. So what we say is that please don't leave that to chance. Don't send out mails to a lot of investors assuming that they will respond. So our Discover engine helps you to kind of identify the set of investors who will be most appropriate, right? Who will be most appropriate for a venture. And this list will be constantly updated depending on the recent investments and the patterns of the investors. So what we give a recommendation might not be valid forever and ever, but it will be valid only for the next month or so, because as we get more information about the investors, more investments about the investors, then we will keep on revising the recommendations. So this Discover engine helps you to quickly identify who will be your target investors, who can be the investors that you can start with, right? And this will dramatically reduce your frustration and increase your chances of funding. So this brings to the end of my presentation. So I can probably stay for a few minutes and answer any questions that you would have. I'm opening the chat box to see any questions. So Ganapati could ask the question, startups with part-time employees are able to attract seed investment. Yes, they can attract seed investment, but many times the seed investment will come with the conditionality that the investment will happen only after the employees join full-time, or not employees, or only after the founders join full-time, right? So founders need to be full-time, but there are no restriction that employees need to be full-time as well, right? There are many startups which are run with part-time employees because startups do not want to create major overheads. Right? So they would want to keep as minimal overheads as possible. So it's okay to have part-time employees provided the founders are full-time, provided if there are any critical employees or critical function that they are full-time. Having part-time employees is not a major impediment. So that would be my response. Okay, so there are some questions like what would be the typical charges of utilizing your firm's valuation and discover modules? See, basically, I wanted to tell here, we are an entrepreneur first entity. Right? So today, if you really look at it, the investor landscape has increased. There are a lot of investors who are there. And these investors have also created a lot of platforms. A lot of investment platforms are there. So somebody mentioned India Angel Network, somebody mentioned Let Venture, somebody mentioned AngelList.co and all that, right? So these are all platforms that primarily meet the needs of the investors, or they take care of the interest of the investors first. Okay? And we wanted to be a platform that will take care of the investors of the entrepreneurs first. So we are an entrepreneur first platform. And obviously, we understand, being a startup ourselves, the most important commodity for startup is cash, right? I mean, we wanted to keep all our services entirely manageable and affordable to startups. And the way we want to do it is to use technology, right? And we try and use technology, and we try and use data so that we are able to keep our services affordable. So we have a subscription-based model. Currently, our subscription-based model for the technology platform is very, very affordable. It's we are trying to price it at 990 rupees per annum, right? So it's for 1 annum, 1 year. That's the subscription charges, and it gives you access to all the online offerings, not just Discover or Valuation. It gives you access to all the online offerings that are there, and any online offering that will come in the future as well, right? So it's a complete thing, and then you can access it anytime you want. There are no limitations in terms of how many times you can access the offering, because the data constantly is updated regularly. And as the data updates happens, the recommendations that you get may also get updated to the most recent recommendations. So therefore, there are no restrictions in terms of how much you want to, how many times you can get it, right? So that is broadly about YNOS. So what I will do is I will take the help of IIT Madras Alumni Association and send more details about YNOS, and I would encourage you to log in and register. And then I would definitely think you will find it interesting, and then you could probably be a subscriber to that. So what aspects of an investor should we look into before approaching them? So this is a query by Nived Narayanan. Right? So, there are a lot of things. Like, first of all, an investor can be classified into two categories. I mean, if you really look at the angel investor, so the professional investor, and then a financial investor, and then a business investor. Right? So it depends on what you want. Like, let's say, for example, if you don't want an investor who you see as interference, then you may want to approach a financial investor, right? But a financial investor is going to place a lot of emphasis on returns. On the other hand, if you want somebody who would not only give you capital, but will also help you with, insights on running a business, who wants to mentor you, who wants to guide you, then you may want to go for a business angel. So that means angel investors who have been entrepreneurs, successful entrepreneurs themselves, and they are investing because they just want to keep on involved in some kind of entrepreneurial entity or the other, right? So that is second. It's like it's like there are various factors that the investors look at, and one of the important thing is which is going to be very difficult to do it manually. See, for example, on an average, there is certain amount of time gap before an investor makes the next round of investment, right? It's like buying a house, right? Or buying a high involvement decision, making a high involvement decision. An investor who has made an investment is likely to cool off for a certain time before he makes a next round of investment, before he makes a next investment, howsoever attractive it may be, right? So if an investor has made an investment yesterday and you approach again very soon, it's very unlikely that you will get a positive response, because there is always a cooling off period, right? An investor would take some time, see how the existing investment is doing before he goes to the next round of investment. And it is very difficult to keep track of the investments that all of these investors have made and then go ahead, right? So I just highlighted some of these factors, and our technology tool helps you to do a lot more in recommending these investors. Does Winos curate investors, or is it a recommendation engine? So as of now, it's a recommendation engine. I wouldn't know what you mean by. No, do you know Winos who are subscribed to Winos, or will get general investors? Okay, so this is basically, that's a significant difference here, right? The significant difference here between some of the other things that are there in the market and what Winos does. So Winos makes its recommendation based on the past investment patterns of the investors, right? So that means it's not only those who are there in our list, but it also considers all the other investors who are making investment in the marketplace. So we believe an actual investment speaks a lot about the investors rather than intention to invest. So many investors would have an intention to invest, but unless until they have made an investment, it's so difficult to find out whether they are actually serious investors or whether they are just being in the play, right? And the recommendations that we make are actually serious investors who have been consistently making investments, right? And our recommendations are based on those people who have made investments, right? So it's not just a list of people who have expressed an interest to invest. In fact, we do a lot of screening to ensure that we show only investors who have some track record of investing in this space. Okay, we have reached the end of the show time, and I will be able to take your queries offline, but I would encourage you to visit our website, which I am giving here, winos.in, and if you have any queries, you could always send out an email to this address, which I will also give. And I wish each and every one of you a success in your venture, and I hope we will have a chance to interact in person in one of the fora in the near future. And just do take a look at Winos, and as a startup, we will be keen to have your feedback as well. Okay, I think I made a mistake in the email. It should be jeeves@ynos.in. Yeah, I'm thankful to Ajay for pointing out this mistake.